Good morning. Today is Wednesday, April 13th, 2022. That was a song called Bed Bath and Beyond. I had never heard that song before, but it is intentional because Bed Bath and Beyond did report earnings this morning. We will be talking about that toward the end of the call, but we're going to be starting off with an inflation number. Yesterday, we didn't have the call, but we did talk about consumer price inflation at the macro event yesterday, which came in a little bit lower than expectations, especially on the core side, but we're getting a producer price index today, which is coming in hot. Tom, tell us what's going on there.
Yeah, so the expectation was 8.4%, and we came in at 9.2. And if you do or I guess that's the ex food and energy, the headline number is actually 10.6% year over year for final demand PPI, which is a very big number. If you take ex food and energy, we're at 9.2. Ex food, energy, and trade, we're up 7%. So those are all much higher than expectation. And so that's a very, very hot number. I don't think anyone was anticipating that, particularly after the softer CPI number yesterday. If you look at the bond market, it was pretty green this morning. And as soon as that number came out, we saw just a big jump across the bond space, everything selling off. All the way from the 2-year to the 30-year, we're seeing some softness already. So we've got a lot of commentary from Fed representatives to cover, and my initial read on that was that I was surprised that we hadn't seen any move, but now we got this PPI number. I think we're moving upwards for sure, and we'll get into that in the second half of the call.
Yeah, thanks, Tom. Yeah, this PPI number is definitely running hot. I think that is impacted by more transitory impacts. You're going to see a little bit more volatility in the PPI number than you might see in the CPI number. And I do think that the Federal Reserve is a little bit more concerned with the CPI number than the consumer side than the producer side. Nevertheless, we're definitely seeing some inflation really bite on the producer side. And you strip out food and energy, but even if you strip out food and energy, you still have energy derivatives that are playing a role. I mean, even if you take out natural gas, even if you take out oil, you still have the derivatives of that: chemicals, your plastics, your fertilizers. That's all going to your freight costs, which are going to go up. So that plays through the economy, even if you're taking out pure energy prices. So I think that's important to remember as we talk about the inflation that producers are seeing. If we actually look at, wheat prices, that's actually not at the peak. And you do see oil prices that are still down significantly from where they peaked out. Nevertheless, you're obviously continuing to trend upward on those. So Tom, yesterday and then into today, we actually had some more commentary from Federal Reserve representatives. The first was Lael Brainerd. She spoke yesterday, and if you recall, she also spoke before the minutes last week as well. And she actually said that inflation may be monitoring, especially on the core goods side, and she was actually fairly optimistic about that. But Jim Bullard today, the guy from St. Louis, he continues to pound the table on rate increases and wants more and more and more. Where do you stand with these two? First, give us a quick summary of where they stand, and then where you're leaning in terms of who is actually seeing the right signs.
So Lael Brainerd, who, with the exception really of the interview she gave last week, was pretty dovish in terms of where she ranked on the scale of dovishness to hawkishness on the average Fed voting member. And so she basically said that they need to move expeditiously. They've really got to get a handle on, the core CPI. They've got to figure out what core goods are doing and try and get inflationary pressures down. So she's basically saying, we've got to move quickly. We've got to raise rates. And I would say if on a scale of 1 to 5, she's probably about a 1.5 in terms of hawkishness, in terms of those statements. Jim Bullard, on the other hand, came out this morning in an interview with the Financial Times, and he basically said, screw the neutral rate. We've got to get swinging in the pendulum in the other direction, which is we need to get above the neutral rate, raise interest rates above sort of letting not into, like, think of it this way. Right now, we've got our foot on the gas, which is essentially we were buying bonds, rates were at zero, and our foot is still on the gas, but all we did was kind of lift it up just a little bit. He's basically saying not only do we need to take our foot off the gas and get to a point where we're coasting, we need to then slam on the brakes. So the neutral rate would essentially be, we get up to speed and then we coast. So he's with interest rate hikes and functionally get into a position where we're putting on the brakes, which is to say that, if we're on the gas, that means we're pushing inflationary pressures up. If we get to neutral, we're not doing anything. And if we get above that, we put the brakes on, then that should push inflation down. So that's extraordinarily hawkish. I would say that would put him definitely at a 5 within. All right. Okay, moving.
So I think Tom was frozen on that. So I'll just jump in. But basically, to continue Tom's analogy, you're essentially on the gas. The Fed has been on the gas. And instead of lifting up, Jim Bullard saying we need to stomp on the brakes really hard right now. And that may have a chance of the passenger going through the windshield, but that's what needs to be done in order to stop before you just blow through the traffic stoplight. So that's basically what we're trying to do. We're trying to stop before we get to the intersection. And Bullard says, look, our vehicle is too big. We're going too fast. We need to stomp on those brakes. And Lyle Brainerd said, hey, we can take off the gas, coast a little bit. We have some friction. This is not a very smooth road. We're going to slow down anyway. And Bullard said, no, we got to stomp on that brakes. Is that kind of what you're saying, Tom?
Yeah, that was definitely the gist of it. And it's interesting because we've already shrugged off this PPI number. So if you look at interest rates now, what my commentary was going to be this morning was, even with all this, pretty hawkish to a certain degree comments from both Lyle Brainerd and from Jim Bullard, we were seeing increased steepening. We were seeing the short end of the curve getting bought up very strong this morning, which is a net positive, is kind of what you wanted to see. And then we got that PPI number and that reversed, though already while we've been talking, we've gone right back to a steepening situation with the short end being bought up quite a bit. So I think what's happening is the bond market is shrugging off these comments, at least in the short term. They're saying, hey, inflation has ticked up. We're not quite convicted that we're going to get all these rate hikes, despite the fact that everybody's saying we need to just absolutely get, a 10 out of 10 aggressive on them. So I'm interested to see exactly what happens with the futures on potential hikes. We have not moved up on that regard. So we're still looking at, roughly 9.5 for the year. So unlike earlier in the year where someone would come out and make a comment and futures would swing wildly and bonds would swing wildly, we shrugged a lot of this stuff off very quickly this morning. So if that trade holds, it's a very positive move for the fixed income markets, I think, at a stabilizing read through, just assuming that stays the way it is. I mean, we saw that very strong selling for about 5 minutes, and then we've already seen that reverse, which I think is very, very good news from my point of view.
Awesome, Tom. Do you think this plays into the 30-year bond auction later today?
Yeah, so we've got the 30-year auction. Yesterday after we got the soft CPI number, the 30-year was the only part of the curve that was selling off. Everything else was way up. So it's going to be interesting to see how much demand is there. I think the big piece is going to be how much foreign demand is there, because rates have moved up across the board in really every major country. And, China's rates for the first time are actually lower than ours for the first time in history. So you wonder how much foreign demand is going to be there if the opportunity to buy Chinese sovereigns is not as opportunistic as the U.S. sovereign, which is very unusual historically speaking. So that's going to be the number I'm looking for. How strong is the bid to cover? Meaning how many people are bidding on these 30-year bonds, and the question is how many are coming from foreign demand, because I think that's going to be the driver. At least we've seen it over the last year or so, but I think going forward, that's going to be how strong the auction is going to be, how many people outside of the U.S. are piling in to buy our debt.
Awesome. Thanks, Tom. Yeah. So about every 3 or 4 weeks, you'll have the U.S. Treasury needs to raise money, fund the operations of government. They issue debt, and that's done in an auction style. And those auctions are watched pretty closely, because if you see low demand, that means rates are going higher. If you see high demand, that means rates are going lower. Shifting gears onto the equity side, we do have some companies kicking off earnings season. We got JP Morgan, Delta, BlackRock, Bed Bath & Beyond, and Fastenal all reporting earnings this morning. Just a quick rundown here. The conference calls for JP Morgan and BlackRock are ongoing, so we'll have more commentary that we may be able to share with you tomorrow. As far as BlackRock goes, BlackRock is a large asset manager. They have all the SPDR shares. They actually performed fairly well in the quarter. They did benefit from a one-time tax issue that allowed their earnings to beat. But I want to camp out a little bit more on JP Morgan and Bed Bath & Beyond and Delta. In terms of JP Morgan, they, to quote Jamie Dimon, remain optimistic on the economy, at least for the short term. He says consumer and business balance sheets, as well as consumer spending, remain at healthy levels. But they do see significant geopolitical and economic challenges ahead due to high inflation, supply chain issues, and the war in Ukraine. Basically, everything we were talking about from the CEO survey that we shared with you at the macro presentation yesterday. Overall, they actually raised guidance for the full year. Investment banking was a bad point for the quarter for JP Morgan. But if you look at the totality of JP Morgan's results, they're actually okay. They did take a charge from Russia and Ukraine. They did take a charge on just deteriorating potential negative downside risks. He said that recession is not the base case, but they do think about it. So this is a little bit of a shift from what the commentary that we've seen from Jamie Dimon previously. And really, inflation is the big thing that they're watching. Bed Bath & Beyond and Delta give a really good overview of what we were talking about yesterday with that consumer spending shift from goods into services. Bed Bath & Beyond results were about as ugly as they have been, which is saying a lot for Bed Bath & Beyond. Bed Bath & Beyond is a retailer that's really been dying a slow death, as Tom will talk about. It's been dying a slow death for a long period of time. They had a brief renaissance as people invested in home furnishings, but that seems like that renaissance has kind of faded away. Right now, their same-store sales are running at over negative 20% for the first quarter, and that quarter began in March. So we're about halfway through that. So to be running at negative 20% right now is pretty bad. They do say the second half of the fiscal year will be better, but that won't start till October. And to be better than negative 20% really isn't saying a whole lot. So Bed Bath & Beyond definitely getting hit. They're blaming some things on supply chain and saying that actual demand is okay. I'm not buying it. I think that Bed Bath & Beyond is one of the wettest paper bags in the market and in retail. And right now, there's a stone and it just went straight through that wet paper bag. Meanwhile, you have Delta, who's actually returning to profitability. They became profitable in the month of March, and they're going to be profitable for the entirety of the June quarter. For perspective, they're only running 84% of the seats that they ran in June of 2019, but they're going to get about 95% of the revenue that they got in the June quarter of 2019. So 84% of the seats, but getting 95% of the revenue, because they're getting so much more per seat right now. The unit revenue is up double digits over 2019. Operating margins 12 to 14%, and that includes these higher fuel prices. So they're getting very successful in terms of harvesting that demand, and now they're getting more demand from corporations. In fact, corporations, which were about 40 to 50% of 2019 levels in the first couple of months of the quarter, are now 70% of the 2019 demand in March, and international demand's coming back too. So we're really seeing a lot of demand for air travel. Delta stock's up 6% pre-market. Tom, any thoughts on either Delta or Bed Bath & Beyond?
We talked ad nauseum about Bed Bath & Beyond and how terrible of a company and how poorly run it is. So this is not a surprise. The Delta one, I think, is very interesting. I mean, it's definitely no surprise there either. If anybody's tried to book a flight recently, prices are astronomical. And, that's basically the game they can play right now, because they know the demand is rising and they know that people still need to get places, and they can raise the prices to make profitability, which I think is, that's their prerogative. And I think it's just a trend that's going to continue. We looked at the travel percentages, growth last night during the macro, and I think that's just a trend that's going to continue for a very long time. So very bullish on the airlines. I think at least in the short term, until there's our next global pandemic for sure. So something to keep an eye on. But we do have a lot of exposure to Southwest. Southwest, I think, is probably the best bet in terms of continuing to see strength in the domestic travel, versus international. I think international is still somewhat depressed, but as that opens up, I think Delta and United and some of the larger carriers that are doing more international travel will have a little bit more upside, because you're going to get a real premium on those tickets once things really start to open internationally.
Awesome. Thanks, Tom. Thanks everyone for joining us. We'll be right back here tomorrow at 8:30. Have a great day, and we'll see you tomorrow. Bye.